No rate hike. That's the message from the Federal Reserve following its closely watched September meeting. For more analysis, I'm joined now by David Lebovitz, global market strategist at JP Morgan Funds, and Nick Kolas, the chief market strategist at Convergex. And gentlemen, welcome.
Thank you.
Thanks for having me.
All right, Nick, what a day. No rate hike, but do you think we'll see one at some point in 2015? Because you only have 4 FOMC members saying they think we'll see a rate hike after 2015.
Yes, you're right. What a day. There was such a coin flip around this whole decision, and now we finally have it. And it's almost anticlimactic. Like, where's the action? Where's the next step? And the Fed has said we got to wait a little while longer. As far as when the real first rate hike comes, it does seem to be December. That is the next press conference, and it's still within bounds of what the Fed has told us to expect.
All right, David, I want to read a quote from the Fed's statement, which jumped out to me. It says, recent global economic and financial developments may restrain economic activity somewhat and are likely to put further downward pressure on inflation in the near term. Is this the Fed basically saying China is going to be more of a problem than perhaps we previously thought?
Well, I'm not sure that they're talking about China specifically. I think they're talking about emerging markets broadly. Clearly, reading the Fed statement, listening to the beginning of the press conference, they're very concerned with the developments with respect to inflation. So I'm watching inflation very closely. We need to see some stability there, particularly in terms of inflation expectations, in order for the Fed to be comfortable hiking rates at some point later this year.
All right, Nick, a simple question, not necessarily a simple answer, but what does no rate hike mean for stocks? One would presumably think that's good, but what are you going to be telling clients?
We did a piece this morning that talked about how the last 5 days have been very much setting up for a rate increase. Financials were the top performing group. The 2-year went all the way to 81 basis points. And so now the market's got to digest what it means to have a Federal Reserve more worried about the economy than perhaps the market itself has been. So I think it's going to be a period of digestion, thinking through what this signal says about earnings growth in the fourth quarter, about earnings projections for next year. And let's face it, we haven't had really any revenue growth or earnings growth all of 2015. So we've got to now think about what to do with a Fed that now is a little more cautious.
All right, David, you want to weigh in here on what the stock market is going to look like going forward?
Well, I think that the other guest just hit the nail on the head. We need to see earnings growth materialize in order for there to be a reason to buy into stocks. We're headed into the fourth quarter with the possibility of no earnings growth for the past 4 quarters, and so it's imperative that we start to see companies generate stronger cash flows. If those don't start to materialize, I think we're looking at a particularly volatile market, particularly given the uncertainty not only surrounding the Fed, but the trajectory of emerging markets. So watching earnings very closely, that really seems to be the linchpin for U.S. investors at the current juncture.
And Nick, I think many investors wanted the Fed to get this over with, hike interest rates, so we can eliminate that uncertainty surrounding that initial hike. As you know, the markets hate uncertainty. What's your take on the volatility in the markets going forward? Do you think investors will still be obsessed with the Fed?
The short answer is yes, they will be, and we have a number of different hurdles to jump between now and that December meeting. The most important one is that classic volatility in October. On our trading desk at Convergex, we're hearing from clients that they're beginning to think about some tax loss selling in October ahead of mutual fund year end, and that's the kind of thing that usually sets up that October volatility, and now we have to wait till December for the next Fed decision. So it does shape up to be a very volatile final 4 months of the year.
All right, David, I'll give you the last word. Anything to say on the dollar losing some steam against the euro? I mean, how much of the decision to keep rates unchanged was about the dollar? Of course, raising rates would add steam to the dollar.
Well, the dollar is obviously linked to inflation, so I see a pretty strong relationship there. I think if the dollar weakens, that results in a loosening of financial conditions, particularly relative to where we sit now. So watch the dollar, watch inflation, and those will be the best cues for the direction of monetary policy.
All right, gentlemen, of course, a lot to discuss, but we're going to leave it there for right now. Nick Kolas from Convergex and David Lebovitz from JP Morgan Funds. Gentlemen, thanks for your time.
Thanks for having me.
I'm Scott Gamm, and you're watching The Street.